trend is over or when it's likely to continue, would that change the way that you trade? Simply put, market structure is just a series of highs and lows, but not all highs and lows are created equal. So we have to use a tool called manipulation and displacement to tell which we want to pay attention to. Now, first, I want you to take note of what classifies as a high or a low. In this example, I want you to pay attention anything that has a higher low on either side of it, meaning we have a 3-candle formation. This candle is the lowest low. We have higher lows on either side. That is considered a low. And then anything that has a lower high on either side of it, well, that candle is considered a high. Now, what happens at highs and lows tells you everything that you need to know. So pay attention right here. What is happening to this low and this low? Notice we're not closing below it. Now, some people would say this is a break in structure, but they'd be wrong. Because when the market doesn't displace or push energetically through a point of structure, it's likely to reverse. Now, this becomes even higher probability with a market structure shift. All a market structure shift is if we go from making lower highs and lower lows to making a true new higher high. Now, what makes it a true and valid higher high? Well, we created a fair value gap and closed beyond this point of structure. You can use this with liquidity or key level taps, which we'll get to later in the video. Now, another trick that you can use with this is anytime that a low gets manipulated, meaning we don't push through it energetically, and you get a reversal pattern, then you can target the high that failed to do its job, because this high, well, its job was to push us down lower, and it failed to make a lower low. So this gives us a nice target for trades. Now that you've learned liquidity and market structure, let's combine them into how you're going to make money using these concepts, which is market maker models. Now, if you've ever caught a trade that looked perfect and then you get stopped out and it just runs without you, then this is going to explain why and solve that mistake for good. Now, I can't stress the importance of this enough. I mean, just imagine for a second what it would feel like to finally anticipate these stop hunts instead of getting caught in them. So we know that price goes from fair value gaps to swing points, but how do you actually make money on this move? On the higher time frame, we see price trade into a fair value gap and go straight to liquidity, but the lower time frame tells a different story. What you want to look for a market maker model is just 2 or more consolidations on the way down to your fair value gap. Now, consolidation is just when price moves sideways. A lot of traders are going to be early here, meaning they're going to get stopped out when the market goes under these consolidations. What you want to see once the market comes into your higher time frame fair value gap is you want to see a manipulation and then a displacement, creating a new lower time frame fair value gap right here. And this is where you can enter the trade and then take profits at that higher time frame swing point. So this helps you catch the move from this internal liquidity to external. Now, another trick is once this is activated, anytime you come under a low, if you're bullish, then you look at this like a likely manipulation. And if you see that there, you can also catch trades later in the setup or trail up your stops to reduce risk. So let's take a look at this example. We have a consolidation and then we have another consolidation here. At the bottom, we see a manipulation and then the market displaces through a high.